2 days ago, a 74-year-old man in Ohio liquidated his entire silver position, sold everything, took the loss. He told his wife the bull market was over. He had been holding for 11 months. He sold on a Tuesday. By that same Thursday, the largest single silver transaction in recorded market history had just been completed behind closed doors. $4.3 billion, quietly, without fanfare. While the financial headlines were screaming about Iran and the Federal Reserve and the dollar, that man in Ohio did not know. Nobody told him. And right now, there are thousands of people just like him making the exact same mistake, selling the exact right asset at the exact wrong moment because they are reading the wrong story. This video is about the right story, the one that does not make the front page, the one you need to understand before you make any decision about your precious metals position this week or any week that follows. If you have been watching your gold and silver positions go red and trying to figure out what is actually happening, you are in exactly the right place. Stay with me, because the information builds on itself and the conclusion is going to shift how you see this market. If you want this kind of analysis consistently, subscribe to Element Axis right now and hit that notification bell. The precious metals market is at an inflection point where being a week late on information can cost you real money. Now let us get into it. Let me start by giving you the version of events you have already seen, because I want to acknowledge what is true before we get to what is missing. Gold dropped about 1.9% this week, sliding under $4,900 an ounce. Silver got hit harder, falling close to 3% in a single session and pushing towards $74. Every major financial outlet is running essentially the same explanation. Diplomatic talks between the United States and Iran in Geneva over Tehran's nuclear program, a slightly stronger US dollar, uncertainty around Federal Reserve policy, thin trading volumes because Chinese markets are closed for Lunar New Year and the United States just had a holiday weekend for President's Day. Every single one of those things is real. I am not here to tell you the people reporting them are wrong. They are accurate. They are contributing to this week's price action. But they are about 30% of the actual story. And the 70% that is missing is exactly the part that changes how you should be thinking about everything happening right now. Here's the part they are not leading with. While the price of silver was sliding, while retail investors were watching their screens go red and second-guessing their positions, one of the most significant transactions in the entire history of the precious metals market was being finalized in the background. BHP, one of the largest mining and natural resources companies on the planet, completed a silver streaming agreement with Wheaton Precious Metals. The terms are staggering. Wheaton paid $4.3 billion upfront for a share of the silver production coming out of the Antamina mine in Peru over the coming years and decades, not over time, not in installments spread across the future. $4.3 billion committed, locked in, signed. This is not one of the largest deals of its kind. It is the largest, the single biggest silver streaming transaction in the recorded history of this market, and it happened this week. The same week, silver dropped 3%, and every headline was about Iran and the Fed. Think about that juxtaposition for a second. Really think about it, because the contrast between what is happening on the surface and what is happening underneath tells you something profound about the difference between short-term price action and long-term fundamental value. Drop a comment right now and tell me honestly, did you see this deal reported anywhere in the mainstream financial media before watching this video? I am asking because I genuinely want to gauge how well this is getting out. And I suspect the answer is going to be telling. Now, let me explain precisely why this deal matters, because a large dollar figure is easy to hear and hard to internalize. A silver streaming deal is not a stock purchase. It is not a momentum trade. It is not speculation on a short-term catalyst. It is a long-term structural commitment. When Wheaton Precious Metals writes a $4.3 billion check today in exchange for silver produced over the coming years and decades, they are making one specific statement. They believe the silver they will receive in the future is worth more than what they are paying today. That is the only rational basis for this transaction. You do not commit capital that permanently to a commodity you think is going to be cheaper. You do not do it if you think the bull market is ending. You do it when your supply chain data, your demand modeling, your understanding of the structural dynamics of this market, all of it converges on a single conclusion. Silver at these prices is undervalued relative to where it needs to go to reflect reality. These are professionals with access to geological surveys, production forecasts, and industrial demand contracts that most of us will never see. And they just put $4.3 billion behind their conviction. That is the signal buried underneath all the noise this week. Now let me break down the mechanics of what is actually driving the price action, because understanding the how and why of these moves is what separates the investors who stay rational from the ones who make decisions they regret. The first and most underappreciated factor is the holiday liquidity situation. Right now, we have a near-perfect storm of missing market participants. Chinese markets are closed for Lunar New Year, and they will not reopen until around February 23rd. China is the largest single buyer of physical gold and silver in the world. When their markets close for an extended holiday, a massive source of buying demand does not slow down. It disappears entirely. And then layer on top of that the President's Day holiday in the United States. While U.S. markets are technically open, the holiday disrupted normal institutional trading patterns. Many professional traders extend their time off around these windows. Volume drops, active participation thins, and in a thinned-out market, prices become far more sensitive to selling pressure than they would be under normal conditions. Here's a simple way to think about what this means in practice. Imagine trying to sell your house during a week when 40 out of 50 active buyers in your neighborhood happen to be on vacation. The bids dry up. The remaining buyers know they have leverage. The price you can achieve drops not because your house got worse, but because the demand side temporarily contracted. That is what is happening in silver right now. The price is falling not because the fundamentals weakened, but because a significant portion of the natural buyers are temporarily absent. When Chinese markets reopen and institutional participation normalizes, the buying demand that was missing during this window returns. The temporary dislocation corrects. But anyone who sold during the dislocation locked in losses they are not getting back. There is also a more deliberate dimension to this that serious investors should understand. The participants who benefit from lower prices, the large institutions looking to accumulate at a discount, understand liquidity cycles perfectly. They know when the physical buyers will be absent. They know that the same selling pressure that would move silver 0.5% on a normal high-volume day can move it 2 or 3% when liquidity is thin. They know that lower prices trigger stop-loss orders which trigger more selling. This is basic market mechanics that sophisticated players use routinely, understanding that timing is the difference between seeing a 3% drop as a crisis and seeing it for what it actually is. If this kind of real talk about how markets actually work is useful to you, go ahead and hit the like button. It sounds like a standard ask, but it genuinely helps this content reach more people. The more investors understand these mechanics, the fewer people make the mistake of selling at moments like this one. The second factor is the US dollar, and I want to give you the perspective the headlines are leaving out. Gold and silver are priced in dollars. When the dollar strengthens, the dollar price of precious metals falls. The relationship is real. But here's the context almost no one is mentioning. The dollar index moved approximately 0.03% this week, 0.03%. In a healthy market with typical participation, a move that's small barely registers. But in this thinned-out holiday environment, even that fractional tick provided narrative cover for a much larger price move than the dollar fundamentals justified. There's always a story given for why the price moved. The explanation offered is technically true. But the actual driver was thin liquidity and what happens to price when the buy side temporarily dries up. The dollar headline is the story told. The mechanics of a depleted market are the reality underneath. The third factor is the geopolitical situation with Iran, and this is where something interesting is happening from a market psychology standpoint. United States and Iranian officials are in Geneva right now in serious nuclear negotiations. President Trump has threatened military action if a deal is not reached. 2 aircraft carrier groups and multiple warships are deployed to the Middle East. Iran is conducting military drills in the Strait of Hormuz. In almost any other market environment, that setup would be driving precious metals higher. Safe haven demand surges during genuine geopolitical risk. That is one of the most consistent relationships in modern financial history, but that is not what is happening right now. A lot of investors got burned badly in January. Silver ran up quickly and then corrected sharply. People who chased near the top experienced significant losses fast. That creates what traders call gun shyness. When investors have been burned by chasing, they stop responding normally to triggers that typically generate buying. They see a geopolitical headline that should drive safe haven demand, and instead of buying, they freeze. In a thin market, that collective hesitation creates downward pressure even when the fundamentals point the other way. But this is not permanent. The gun-shy momentum chasers are being replaced by investors with longer time horizons and stronger conviction. The base of holders is getting stronger, and when the next leg higher comes, it will be built on a sturdier foundation. The fourth factor is the Federal Reserve. Markets are watching the Fed minutes from the January meeting coming out this Wednesday. Those minutes give investors insight into how policymakers are thinking about the path of interest rates. Any hawkish signal, meaning the Fed leans toward keeping rates elevated, creates short-term selling pressure on precious metals. The theoretical logic is that higher rates increase the opportunity cost of holding gold and silver, while cash and bonds earn interest. The more significant uncertainty right now is around the next Fed chairmanship. President Trump nominated Kevin Warsh, who markets perceive as potentially less accommodative than current leadership. When markets cannot confidently model where policy is heading, the default reaction is to reduce exposure. Funds take chips off the table. The uncertainty itself becomes a headwind regardless of whether the fundamental case for precious metals has changed. And then on Friday, we get PCE inflation data. Hot numbers reinforce the case for elevated rates and create near-term bearish pressure on metals. Cool numbers open the door for eventual rate cuts and support the bullish case. That uncertainty keeps institutional capital cautious and on the sideline between now and Friday. So that is the complete picture of why prices are down this week. Holiday liquidity drain, fractional dollar strength providing narrative cover, gun-shy investors not responding normally to geopolitical risk, Federal Reserve uncertainty keeping big money cautious, all real, all contributing. None of it changes the structural story. And the structural story is where real money is made and lost over time. Let me give you the numbers that the price action is currently ignoring. The silver market is projected to face a deficit of 67 million ounces in 2026. That is the consensus projection from the Silver Institute and the major commodity research organizations that track physical supply and demand. 67 million ounces more consumed than produced in a single year. And this is the 6th consecutive year of deficit. Every year since 2021, the world has consumed more silver than it has mined. The cumulative shortfall across those 6 years now exceeds 800 million ounces. That is the equivalent of an entire year of global silver mine production absorbed into the economy and permanently consumed. Built into solar panels, circuit boards, medical equipment, electrical infrastructure, and investment holdings that are not coming back to the market. Exchange inventories are at multi-year lows. Physical premiums in key markets are persistently elevated. The market is telling you something in the physical data that the paper price has not yet fully acknowledged. And the professionals who just committed $4.3 billion to secure future production clearly believe that acknowledgement is coming. Go ahead and share this video right now with someone you know who is watching their precious metals position go red this week and is not sure what to make of it. Someone who worked hard for decades building their savings and is now confused by what they are seeing. The information in this video could genuinely influence the quality of the decision they make in the next few days. Now let me walk you through the technical picture, because understanding where price is likely to find support is practically important for anyone making decisions right now. Silver is trading in the range of $74 to $76 an ounce. The 50-day moving average is up around $80.84. The 200-day moving average is higher still at around $84.30. By standard technical analysis, trading below both major moving averages with downward momentum is a bearish setup. Lower highs, lower lows, price below key averages. If you look only at the technicals, the picture is not constructive. But I want to be direct about the limitation of technical analysis in a market like this one. Technical indicators measure price behavior and momentum. They reflect current sentiment and near-term positioning. They do not measure fundamental value. They do not account for 67 million ounce annual supply deficit. They do not factor in the largest streaming deal in the history of this market. In a structurally balanced commodity market, technical signals carry significant weight. In a market where the supply and demand math simply does not work at current prices, technical analysis is useful only as a short-term navigation tool. Using it as a long-term guide in this environment is how investors end up selling at exactly the wrong moment. That said, the specific levels matter for near-term positioning, so let me be precise. The first level to watch is $79.42. This is the key resistance point that silver needs to reclaim to signal the correction is shifting into recovery. As long as silver closes below this level, the near-term bias remains bearish and lower prices are possible. The second level is $74.11, last week's low and immediate support. A convincing close below this level deepens the correction. Automated stop-loss orders kick in, potentially creating a cascade effect. The third level, this is the one to pay close attention to, is $72.86. If silver breaks below this level on a closing basis, the door opens to a much deeper correction, potentially all the way to the $64 to $68 zone. That would represent a painful retracement of the January rally and generate headlines declaring the bull market over. But at $64 to $68, you would be buying a structurally deficit metal with surging industrial demand at prices the most informed buyers in this market would view as extraordinary value. The question is not whether the fundamental story is intact at that point. The question is whether you have the psychological discipline to act when the price feels the worst. Let me also talk about the gold to silver ratio, because it gives you useful context about what to expect on the next move higher. The ratio currently sits at approximately 64 to 1, meaning it takes about 64 ounces of silver to buy a single ounce of gold. This ratio has been expanding during the correction, meaning silver has been underperforming gold. That is typical in sell-offs. Silver has a dual identity as both a monetary metal and an industrial metal. In risk-off environments, both dimensions get repriced and silver falls harder. But in precious metals bull markets, silver tends to significantly outperform gold because of that same dual nature. The ratio contracts sharply. At 64-1 and expanding during a correction, the ratio is essentially storing energy for the eventual release. The same dynamics causing silver to underperform now will cause it to outperform when the trend reverses. Patient investors see this not as a warning, but as a setup. Now let me give you a practical guidance for different situations. If you already hold physical gold and silver, nothing about this week changes your fundamental position. You hold real tangible metal that exists outside the banking system that cannot be inflated away by a committee decision. The daily and weekly price fluctuations on your screen are noise. Your time horizon as a physical holder is years and decades. Over that horizon, the structural forces pushing precious metals higher are not fading. Stay patient. Corrections like this are a normal feature of every major bull market in history. If you are accumulating and looking to add, this correction is giving you better prices than you had several weeks ago. Do not try to call the exact bottom. Build a plan with specific price targets made when you are thinking clearly. If silver goes to 72, put some capital to work. If it pulls back to 68, add more. Dollar cost averaging across a range removes the burden of needing to be precisely right on timing. If you are an active trader, this week carries real risk. Thin liquidity combined with multiple high-impact data releases makes this a dangerous environment for aggressive positioning. The Fed minutes, Wednesday, and PCE data Friday are both capable of producing outsized moves in either direction. The Iran talks are a live wildcard. If you cannot absorb a sudden adverse move overnight, reduce your size significantly or stand aside. Protect your capital. The opportunities will still be there after this window closes. Let me now zoom out to the bigger picture. Global debt has reached levels that historically resolve through only two mechanisms, inflation or default, and governments almost always choose inflation. Central banks have printed money at a scale that would have seemed unimaginable a generation ago. The dollar's reserve currency status is being challenged in ways it has not been in decades. These are structural shifts, not temporary conditions, and their implications for hard assets with genuine physical scarcity are profound and durable. For silver specifically, the industrial demand story is one of the most compelling narratives in commodity markets right now. Solar energy infrastructure is being built globally at an accelerating pace, and silver is a non-negotiable component of every solar panel. AI infrastructure is being constructed at a frantic pace, and the hardware that powers it contains silver throughout. The electrification of transportation continues consuming silver in quantities growing year over year. These are the foundational infrastructures of the 21st century economy running on silver in quantities that current mine supply cannot provide. 6 consecutive years of deficit is the physical proof of that reality. The demand is structural. The supply is constrained. Price has to move significantly higher to rebalance the market. That is not a prediction. That is how commodity markets have always worked. The January spike, when silver ran to extraordinary levels in a short period, was not the end of the story. It was a demonstration of what is possible when buying pressure meets constrained supply. It showed the mechanics and the speed at which this market can move when conditions align. The correction that followed showed what the paper futures market can do when physical buyers are on holiday and leverage needs washing out. The paper market can push prices around in thin windows. Stop losses get triggered. Leverage positions get liquidated. Headlines declare the bull market finished. But through all of it, not a single additional ounce of silver was created. The deficit did not shrink. The physical reality remained exactly what it was. Only the paper price changed. And if you understand that distinction, you will make very different decisions than the investors who sold everything because the chart was going down. There are 3 types of people watching a video like this during a week like this one. The first type sees the red numbers, reads the negative headlines, and sells. They lock in losses. They tell themselves they will buy back in when things settle down. And of course, by the time things settle down, the price is recovered and they are chasing it again, buying high after having sold low. The second type freezes. Too much uncertainty, too many conflicting signals. They watch from the sidelines, unable to commit, paralyzed by the possibility of being wrong. Sometimes this avoids near-term pain, but it almost always means missing the opportunity when it counts. The third type treats moments like this as information. They look at a $4.3 billion commitment to future silver production, and they extract the signal from it. They look at 6 consecutive years of structural deficit and recognize that this does not resolve at lower prices. They look at thin holiday liquidity and recognize it as a temporary mechanics-driven dislocation, and they act accordingly, methodically, without emotion, according to a plan made when thinking was clear and the chart was not going red. Let me close with this, because I think it is the most important point in this entire video. The people who authorized and executed the $4.3 billion streaming deal are not casual investors reacting to a news cycle. They are sophisticated commodity investors with access to better data and better analysis than virtually anyone outside those organizations. And they just made the largest commitment of its kind in the recorded history of this market. In the same week, the price dropped 3%, and every retail headline was about Iran and the Fed. They looked at all of that, and they wrote the check anyway, because they understand something the headline readers miss. Short-term price action and long-term fundamental value are two different things. Right now, those two things are diverging in a way that creates a rare opportunity for investors who can see past the noise. Subscribe to Element Access and hit the notification bell because the catalysts hitting this market over the next few weeks are going to matter. The Fed minutes, Wednesday, the PCE data Friday, the reopening of Chinese markets, all of it will move things. You need to be informed ahead of those moves. Drop a comment telling me where you're watching from and what your current strategy is. Are you buying this correction, holding through it, or waiting on the sidelines? Smash the like button if this analysis helped you see the market more clearly, and share this video with someone who needs it. The real story in this market is almost never on the surface. It is in the data, in the big transactions, in the structural forces that take months and years to fully play out. Stay patient, stay informed. The fundamentals have not changed. They have only gotten stronger.